While US markets are slipping into chaos, Warren Buffett is quietly making one of the boldest moves of his career. Instead of buying more stocks in America, he's selling them, offloading over $140 billion, 0 cents worth, of US equities, including major positions like Apple and Bank of America. He's holding record levels of cash, and yet he's buying big, just not here, doubling down in Japan. Buffett's Berkshire Hathaway now owns nearly 10% in 5 of Japan's largest trading houses, conglomerates that operate across energy, food, finance, and more. While everyone's focused on US tech stocks and recession fears, Buffett's quietly building a new empire overseas. But why is he pulling out of the US and going all in on Japan? And what does that tell us about where the smart money sees the future? We're breaking it all down. So if you want to know what Buffett sees coming, make sure to hit that subscribe button now, and let's go. So Buffett didn't just talk, he took action. In 2025, Berkshire Hathaway raised its stake in 5 of Japan's biggest trading companies: Itochu, Marubeni, Mitsubishi, Mitsui, and Sumitomo. These aren't small bets. He now owns over 8% of each, nearly a tenth of 5 of the most powerful business empires in Japan. And this isn't just some passive investment. Buffett actually flew to Japan, met with executives, and made it clear this is a long-term play. To back it all up, Berkshire even issued yen-denominated bonds, borrowing in Japan's currency to help fund these moves. That's a rare move for an American company, and it shows how serious he is about this pivot. So why Japan? Why now? First, let's talk about valuation. These Japanese trading houses are undervalued by traditional standards. They have low price-to-earnings ratios and trade below their book value. 2 classic signs of a Buffett play. It's what he looks for: companies that are worth more than the market gives them credit for. In simple terms, this means these companies are a good deal. When you look at their stock prices compared to how much money they actually make, they're trading at prices lower than they're worth, something Buffett loves. Then there's the cash flow. Many of these companies pay strong dividends, around 3-4% or more. Buffett is all about that steady, reliable cash flow, and these companies have plenty of it. To put that in perspective, if you invested $1,000, 0 cents, you'd get $30, 0 cents, to $40, 0 cents back every year just from dividend. Buffett loves this because it's a reliable way to make money even if the stock price doesn't go up much in the short term. But it's not just about undervaluation and dividends. These aren't just your average trading firms. They're diversified, operating across sectors like energy, food, logistics, mining, and finance. They're conglomerates, much like Berkshire Hathaway itself, with businesses all over the map, which makes them much more resilient in times of economic uncertainty. Think of it like a person who has multiple sources of income. If one source dries up, they have others to rely on. That's exactly what Buffett likes: companies that can weather different kinds of economic storms. Finally, Japan's corporate governance is changing. In the past, Japanese companies were known for being more shareholder-unfriendly, but that's shifting. More buybacks and dividend payouts are becoming the norm, and companies are taking a more modern approach to managing their businesses. It's exactly the kind of shift Buffett has been waiting for. Now, Warren Buffett doesn't usually invest outside the US. He's known for sticking to American stocks. But when he does go global, it's always big, and it's always strategic. Let's take a look at some of his past international bets. In the early 2000s, Buffett made a major investment in PetroChina, a company that was largely overlooked by other investors at the time. That turned out to be one of his best moves. The stock shot up, and he made a 10x return on his investment, a huge win. Then there's BYD, a Chinese electric vehicle company. Buffett saw the potential in the EV industry early on, and his investment in BYD has paid off big time, turning into a multi-bagger investment. That means the stock went up several times the original value. It's one of the biggest successes in Buffett's global playbook. So, what does this tell us? Buffett tends to invest when he sees undervalued assets that others are overlooking. He doesn't buy just any international stock. He looks for companies that are ignored by most investors but have strong potential. That's exactly what Japan offers right now. Japan's market is filled with cash-rich companies that are undervalued, just the kind of companies Buffett loves. These are businesses that have been around for a long time, but for various reasons, the market hasn't fully recognized their worth yet. Buffett's betting on these companies to rise in value as the world catches up to what he's already seen. So why did Buffett choose these 5 specific companies? Let's break down each one and see why they're such smart investments. First up is Itochu. This company has a strong presence in consumer goods. Think of major brands like Family Mart, one of Japan's largest convenience store chains. Itochu is involved in everything from retail to food and clothing, making it a major player in everyday products that people rely on. This gives them stability, especially during economic downturns, because consumer goods are always in demand. Next, we have Marubeni. Marubeni is deeply invested in energy and infrastructure, 2 sectors that are crucial to any economy. They're involved in everything from oil and gas to power plants and construction materials. These industries tend to do well no matter what's happening in the stock market because countries always need energy and infrastructure to grow. Then there's Mitsubishi Corp, a massive conglomerate with fingers in nearly every pie. They're involved in finance, chemicals, and energy, just to name a few. Mitsubishi has its hands in so many different industries that even if one area struggles, they're strong enough in others to keep moving forward. It's one of the biggest, most diversified companies out there, making it a solid choice for someone like Buffett, who loves stability. Now let's talk about Mitsui. This company focuses on natural resources and commodities, things like metals, energy, and chemicals. With global demand for these materials constantly rising, Mitsui is in a great position to profit from industries that are essential to everything from manufacturing to technology. Their focus on natural resources helps protect them from market fluctuations, because these products will always be in demand. Finally, we have Sumitomo, a company with a diverse portfolio that has been around for centuries. Sumitomo is a legacy industrial empire, involved in everything from steel production to financial services. Their long history and diversified business model make them a stable, reliable player in any market. Each one of these companies is like a mini Berkshire because they have operations in multiple sectors, which helps them hedge against economic downturns. If one sector struggles, the other sectors can balance things out, making them more resilient and less risky. This kind of diversification is exactly why Buffett loves them. So, what does this mean for global investors, and why should you care? First, let's talk about retail investors. Right now, many retail investors are focused on chasing the latest hype stocks, companies that are getting all the attention but might not actually be the best value. Meanwhile, Buffett is taking a completely different approach. He's not jumping on the next trending stock. Instead, he's looking for value abroad, specifically in Japan, where there are massive opportunities in companies that are undervalued and generating steady cash flow. While the hype train is running full speed in the US, Buffett is quietly making billion-dollar moves in a market that most people are overlooking. Now let's look at Japan's Nikkei index. Recently, it hit a 34-year high, showing signs of growth, but it's still cheap compared to the US market. Japan's stocks are trading at much lower prices for the value they offer. In other words, Japan's market is still a bargain, especially when compared to the inflated prices of US stocks. This is exactly the kind of opportunity Buffett loves, buying into a market that's poised for growth, but hasn't yet been fully recognized by the mainstream. What's even more interesting is that this could be part of a bigger shift. Buffett might be signaling a pivot, moving his focus away from the tech-heavy debt-fueled markets of the West and into undervalued, cash-rich markets in the East. This move could mark the start of a trend where investors start shifting their attention to more stable, diversified markets outside the US. And it's not just Buffett. Other heavy hitters like George Soros and BlackRock have also started making moves in Japan. If these big investors see something in Japan's trading houses, it could be a sign that more institutional money is going to flow into the market. Warren Buffett isn't just buying stocks. He's sending a clear message. While the world's focused on the ups and downs of the S&P 500, Buffett is quietly doubling down on Japan's trading giants. These are companies that most people are ignoring, but not him. He's seen something others haven't. and he's betting big on the future of Japan. Now the real question is, will you follow the crowd, or will you see the opportunities Buffett is pointing to before everyone else does? If you want more breakdowns on global investing plays before they hit the mainstream, hit that subscribe button. Don't miss out on the next big move.